Tokenized revenue as a new asset class. Probably a great presentation, as I can see, right? Led by Jarek Bialek, managing partner at Revenue Capital. Hi, Jarek, welcome. There's the clicker, there's the microphone. The stage is yours.
All right, does it work? Yes, seems like. Let me check how it works. All right, fairly simple. Okay, so tokenized revenue. I can imagine you probably expect a pretty robust, geeky, and technical presentation, right? Of course you do. Of course. Considering it's actually Friday afternoon after lunch, I'm going to take it easy, so bear with me. Very quickly, my name is Jarek. I'm the CEO and the co-founder of Revenue Capital. Revenue Capital is an alternative fund, and the name is actually not a coincidence, as we practice what we practice what we preach. Meaning that the very foundation of this fund is based on the tokenized revenue, which becomes a fuel of our investment process. But no worries, I'm not going to talk about the company. I'm going to talk about this underlying process, the underlying asset, which is revenue, which is the tokenized revenue. Okay, who of you knows a company called Brand24? I believe that some of the marketeers from here might have heard about it. Okay, we have some signs of, knowing this company. So Brand24, it's a media monitoring tool. And moving us back, a few years in time, back in 2011, the guy who's on the top, his name is Mike Sadowski. He founded this company, and a couple of years after, he was met with a pretty huge dilemma. He was having a product which was robust, which was, having a proven product market fit. It was ready to scale. The question was how this scaling up should be funded. And back then, absolutely most of the opportunities which were there on the market were somehow related to giving equity. So if he wanted to raise some funds for a quick scale-up, he had to go through a regular fundraising process based on equity valuation, based on eventually giving this equity to, whoever would agree to give him money. So Mike is worried, right? I mean, he's worried that, he's still early, when it comes to his market journey. It means that most likely the equity he's going to give away is going to be valuated pretty low. So the sooner you start, the lower the digit on the price tag hanging on your equity is going to be. And that's kind of the worry, of most of the entrepreneurs, actually even today, right? So this represents a certain cost. A cost which you have to pay in the future, a cost which is eventually associated with a lost opportunity, meaning if you give too much equity too early, this might slow down your further progress. So the further you go, the slower you might grow later on, if this growth is supposed to be powered by your equity. So fortunately, Mike found a solution, and the solution lies within a company which provided him with this funding on a pretty short notice, 660K in total, not on the equity-based scheme, based on revenue, in fact. So the way how it works, Mike asked for a certain amount of money. The funding company, looking at the traction, looking at his, market, his business traction and his financial traction, agreed that the requested amount is reasonable and provided him this funding in exchange for claiming certain shares of the revenue Mike's company, Brand24, was supposed to produce in a given amount of time, okay? So Mike got 660K. He funded his global scaling process with this money, reaching approximately 360 customers and becoming a global brand. So this is not something which is unheard of, actually. There's companies, even if you probably haven't heard about the so-called RBFs. RBF, by the way, stands for revenue-based financing. This is the exact scheme I've just described. So RBFs are actually booming right now. And the reason why they're booming, I mean, COVID probably helped a little bit. So, back a few months, maybe a bit more than a year ago, there was a certain shortage of the VC-backed funding. And in order to, again, being provided with the VC-backed funding, a certain VC needs to do a proper evaluation of your equity. They need to understand the risk which your equity represents. They need to understand the market you are operating within, the opportunities of this market, the customer acquisition cost, and so on and so forth. So, all this in a huge market uncertainty, which COVID brought to our reality a while back, well, this is hugely, hugely difficult. So this gave a certain boost to alternative funds based on the revenue, based on, other means of funding. But RBFs are definitely one of them. And what you can see behind me, there are a couple of raising stars right now. One of them is called Uncapped. Uncapped raised approximately $80 million in May this year only. And more funds like this are coming. So speaking about RBFs, one of the reasons there's a very clear need these days for alternative forms of funding is the fact that we are not only facing COVID, right? I mean, we're also facing quite a few different business models. And those business models are provided by the companies which are having pretty unheard structures so far. I mean, think about NFTs. Like, how do you evaluate NFT? How do you evaluate the opportunity derived from an NFT or NFT creators? I mean, the whole blockchain sector brings in the whole, yes, opportunities, but also challenges on the funding side. So this is calling for a certain change in not only evaluating, the opportunities, but also the providing funding, also the timing of this funding. Okay, so speaking about now RBFs, revenue-based funding. This model is with us already for a while. It wasn't necessarily invented shortly ago. As nice as it sounds, yes, it sounds nice, from the customer perspective, from the company perspective, being provided with the RBF funding. It's flexible, yes, it's flexible. It provides those funded companies with a certain second breath in the time of, not being worried so much if the market goes down, because when the market goes down, the revenues go down, eventually they will be paying less, right? As all they pay is the share of their revenue. Now, think about investors in such schemes. Not so sweet, okay? Not so sweet as, well, they still invest, after all, in risky ventures. They're still scaling up startups. Are still companies investing in technology or being powered by technology, moving in the direction which is fairly much unknown. It's a risky business. So, like having or being provided with a 5 to 15% of the annual return doesn't sound so sweet. So, this is my point right now. So, what if this revenue-based funding model introduces revenue as a product? When revenue derived from the portfolio companies, so this share of revenue produced by this portfolio companies is considered as a standalone product, a product which is listed on an exchange, which is liquid, meaning you can buy it, you can sell it, you can speculate against it. What kind of opportunities this model and this product provides? So let me walk you through very quickly how it works, okay? So in the very center of this chart, you have an RBF. In this case, it's a tokenized RBF, probably we should call it this way. So how does it raise funding? Not in the classic way, it's issuing a token. If you look at the top of this chart, you're seeing investors. Investors are buying those tokens and providing funds in form of cash, in form of crypto back to the fund. The fund is using this cash, is using these funds to fund the companies, which are on my left-hand side, okay? Those companies are producing revenue. The revenue is kind of chopped in this way that a certain share of those revenues is going back to the operator, is going back to the fund. And in theory, well, this story could finish, right? I mean, this is how a classic revenue-based financing model works, but it doesn't stop here, okay? Something else is happening. Remember about those tokens issued at the beginning? Those tokens, now looking down, are listed. They're listed on an exchange. The money provided by the revenue share derived from those portfolio companies is going to the market, is provided to buy back a certain amount of tokens. The tokens represented by the exact money provided, taken from the revenues generated by those portfolio companies. What is happening next, 50% of these tokens is destroyed. The remaining 50% is being reinvested in the system. Why we're talking about destroying 50% of those tokens? In order to provide, additional boost to the price leverage, to maintain the price, to stimulate the price growth by decreasing the supply of those tokens on the market. So that's one of the ways and one of the models how a tokenized underlying asset, in this case the revenue, can work. Why do we do that? I mean, why do we bother building such a complex structure? Now, when I told you about the returns investors in classic revenue-based financing systems get, 5 to 15%, in this case, the revenue represented by those tokens provides an additional, way increased opportunities to speculate against the revenue generated by the portfolio companies. So if you picture yourself, and by the way, the investors, I mean, we could all be investors in such a scheme. You, me, it's fully democratic. So if you think about those investors, they are buying those tokens, perceiving a certain movement, a certain traction of this revenue generation. If they all agree that the revenues will keep growing, they are purchasing the rights to future revenues generated by this portfolio. So they enter a brand new market in this case, and this new underlying asset, being the revenue, provides them with these opportunities. This is having a certain further real economy application, speaking about this model. So I just gave you one example based on revenues produced by the portfolio companies, which is disrupting the classic VC model. But those applications can actually touch aspects like real estate, like farming, like quite a few other sectors as well. Why real estate, why farming, by the way? So if you think about profitability of certain sectors, let's think about real estate. I mean, we're talking about a fairly flat curve, which is either growing very slowly or it's pretty stagnant. So we're talking about revenues which are generated in a pretty steady way, but the returns are low. When it comes to farming, it's probably fluctuating a little bit more. So what we're seeing, well, it's a highly unpredictable market situation when, we have weather conditions, we have, other correlations which are either stimulating or destimulating the price growth of the certain crops. So what if we can apply this model to those two sectors? Again, it's like if we purchase future revenues generated by those given models or by those given underlying sectors. So I'm leaving you with this thought as some food for thoughts for later, maybe. In the meantime, if you have any questions, well, I'm here, or I'll be here around, okay? Thank you very much, guys, Thank you for your attention.
Let's give it up. Let's give it up for Jarek Bialek, everyone, managing partner at Revenue Capital.